We start today's market talk. The stock market never changes. Market structure, liquidity, and costs may have changed, but volatility is constant. You will see huge spikes during crisis, as we have seen during COVID times or global financial crisis, etc. But you can't get rid of fear, greed, panic, euphoria, anxiety, or FOMO. Whatever happens in stock market today has happened before and will happen again because human emotions don't change. Market outlook, as I see it, there isn't much in the way of government's vision that isn't already well known. What is required is a timeline for implementation and the announcement of new mega projects. In 2021 budget itself, FM had made full reference to privatization, sale of equity in government companies, increased spending on infrastructure, stressed asset resolution companies, FDI, PLI, selling government land, ports, airports, road, etc. So what people are looking for is timeline for implementation now. FI inflows into Indian equities should pick up with rate cuts looking imminent in the US. So though post-election FI inflows have resumed, but FI inflows will be strong post. There is a talk about rate cuts in US. In addition, liquidity from DIs and retail will keep the broader market valuations elevated. Considering the dizzying heights at which markets are trading, they are very vulnerable to any disappointment. While disappointment is one side, but immediate trigger should be Q1 earnings, a positive news flow from budget, and if Fed surprises with dovish comments on a rate cut as early as possible, it will lead to continued FI inflows. If a business shows consistent growth or if there are green shoots for a business, that would be a good time to accumulate that stock. PMI numbers show that private sector accelerated in June. Manufacturing PMI came at 58.3 in June, with firms expecting further improvement in demand and order book in the year ahead. It will be pragmatic to provide fiscal support to consumption, as firms will add capex to cater to improved demands. TCS Q1 FY25, the underperformance could reverse now. TCS showed strong execution due to baseline order, better margins despite revision of compensation, meaningful headcount addition, revenue grew by 1.9% in reported currency and 2.2% in constant currency. Company is now executing 270 AI projects. It has 1.5 billion AI deal pipeline and is reskilling workforce in AI. FY26 expected EPS is 160. So it can easily trade at around 30p. So levels up to 4,500 to 4,800 are possible. Budget could expedite the energy transition, likely push to semiconductors and boost to infrastructure, which would aid the cement sales. Priority on residential rooftop solar scheme, green hydrogen, battery energy storage system, solarization of agricultural pumps, offshore wind energy to expedite India's energy transition, stable and predictable solar and wind tariffs, incentives for biofuels, etc. are expected in the budget. Semiconductor manufacturing process consisting of design, semiconductor foundry or fab, where silicon wafers and ICs are manufactured, packaging and testing, OSAT, outsourced semiconductor assembly and test, requirement for of high purity gases and ultra pure water will all get a fillip in case there is a focus on semiconductors. A boost to infra would be there along with housing and manufacturing, which would support cement sales and prices. In the US, Fed Chair Jerome Powell hinted at interest rate cuts along with June CPI, which came in softer than expected. So bets of 25 basis point cut in September has gone up to 90%. US markets continue to trade higher. Now, if you see here, The US 10-year yield corrected and has come down to 4.18. And moment there is a clarity on 25 basis point cut, it'll come to this 3.8 level and then lower. But the trajectory is now, if you see the trend, is lower. Dollar index also weakened. It came down to around 104 levels and is expected to go down first to around 101, 102 levels and then below 100 levels as there is more clarity on rate cuts. The weakening dollar will help all the commodities. So the gold and the base metal should do well. Brent crude corrected last week because probably the hurricane season passed off not much of damage. So the production resumed and other activities continued. Gold prices shot up after the talk about a possible US rate cut. It is heading towards its all-time high. Now it has reached 2,400 uh, level, $2,400 to ounce level, and is expected to go up. Copper had a small correction, but it was bought into. So I think it should do well with the focus on electric vehicles and other technologies related to that, where there is a big requirement of copper. S&P 500 made a fresh high uh, and stopped at 5,600 levels. It is being boosted by the big tech, but now the focus is shifting to other sectors of the US economy like banks and small caps. So US economy remains strong and continues to trade higher. India VIX was subdued, but it went up but came down. So it has come down to around 13.7 odd levels. So it will remain slightly excited, keeping the upcoming budget and the earnings in the mind. Government bond yields corrected a bit, came down to 6.98 level, and it should be beneficial to banks because they are the largest holder of bonds. Now, talking about Nifty 50, uh, Friday's price action has put the index into new territory. So, after a midweek dip, Nifty was got bought into and formed a new high due to basically oil and gas and IT stocks, and FI continuing to put money at high levels, while they remain long also on futures, while retail is short. So it has broken above the rising trend line level. So this looks very positive. On the daily chart, if you see on 3 days were negative, 3 days were negative, but 2 days and especially Friday saw it reaching fresh high of 24,500 plus levels. So it continues to remain strong. Nifty Bank was subdued, less enthusiastic, and had a slightly negative bias during the week. Uh, Private banks have to perform better, otherwise Nifty will continue to drag. Now, if you see here, it has dragged, but still it has broken out, so it momentum is okay. On the daily chart, if you see here, it had again three red candles and two green candles, and it tried to go down to 20 EMA but was bought back. And then at high levels, the selling came on Friday. So it remains in a mood of consolidation. We'll have to see from where it goes, but this 52,000 level will not easily break on Bank Nifty. Once it breaks, then we will see lower levels. HDFC Bank, it had gone to that anticipated target, but then has corrected. Now the 1600 level is important. If this one gets broken, then it will go to 1550, 1560 level. So watch out for that. Momentum is done. So that is the key issue. Reliance had broken out from the supply zone of around 3,000, and now it is headed higher. It has reached that 3,200 level. So it should continue to do well based on positive news flow on Geo and IPO and other issues. The best performing sector, which had 3.45% rise in the last week, was Nifty IT. Made on a weekly chart, it made a good cup and handle and has broken out. So watch out for this level of 39,200 odd, which is its all-time high. Once this breaks, then you should first see 40,000 and then higher levels. The leader last week was TCS, as I brought out, based on better than expected results. So it had a big, strong green candle. It has broken above the 20 EMA and is now headed towards its all-time high of around 4250. And then beyond that, it can go to 4500 or 4800 levels. Momentum is very strong. RSI is around reaching around 70 now. Midcap index, if you see here, it made a fresh high but formed a doji. But that is normal. It has run up very hard from last year onwards, constantly trading on weekly charts above the 20 EMA. So some bit of consolidation is okay. Similarly, with small cap, they also formed a doji. So let's see where it goes, but a lot of it will depend on liquidity and money flow. Now I'll cover a few stocks. First is Gail. It could benefit from 10 to 12% tariff increase, potentially boosting the company's FY26 expected PAT by 5%. The refining, power, and CGD, that is city gas distribution sectors, are expected to drive the majority of 20 SCMD increase in volumes. SCMD is million metric standard cubic meter per day. It is doing around 16,300 crore worth of transmission projects and 13,100 crore of petrochemical projects. PDH, and JBF petrochemicals are scheduled for completion in the next 2 years. Now, PDH, is propane dehydrogenation and polypropylene. These are the polymers which they are working on, and they had acquired JBF petrochemicals. And they are doing capex there for manufacturing of 1.25 million ton per annum purified terephthalic acid plant at Bangalore Special Economic Zone. So these projects are likely to complete in the next 2 years. So FY26 ROE will be 14.6% due to impending end of capex cycle. There are no mega projects in pipeline except for ethane cracker project, which is still in the initial stages of evaluation. During FY24-26, PAT is reported at 8.2% CAGR, driven by rise in natural gas transmission volumes to 137 SCMD in FY26 from 120 SCMD. It has basically three businesses and gas transmission, which is the major business, gas trading and petrochemical. So all are expected to do well. Substantial improvement in petrochemical segment profitability over second half FY25-26 as per new petrochemical capacity will be operational and low inventories globally will drive restocking demand, thus improving spreads and healthy trading segment profitability with EBIT guided at 4,000 to 4,500 crore. So if you see here, transmission volumes are improving and they are expected to reach this 137 SCMD level in FY26, and EBITDA is likely to be around 56 billion, that is 5,600 crore. Gas transmission EBITDA is expected to increase. So improvement in volumes, tariff hikes in transmission business, and end of investment cycle, which can lead to ROE, ROC going up, ROE reaching around 14.6% level. So that will be sustained. And 4,000 crore of free cash flow for Gail in FY26 because capex would have stopped at that time. Now, Gail is expected to do around, their volumes are, sales are improving, but the basic reason why the profits are expected to do better is because of better margins. So they are expected to do around 16 rupees EPS in FY26. At 15-20 times PE, it can easily trade at 240 to 320 levels. So keep this stock in watch. Has a decent dividend yield of around 2 to 3%. So this is stock for long term. This is a chart. So if you see here, it was moving along the conjoined moving averages till around last year, May, June. And after that, it took off on better performance and has now reached nearly doubled and has reached fresh all-time high of around 230 odd. So it's moving along a rising trend line and it is expected to be performing well. So it can be looked at and bought at every dip. ONGC, it's a value buy trading at, you will see now, 0.9 times consolidated FY26 price to book. KG 98 by 2 and Daman's upside potential will act as near to medium-term production growth engines. Petrochemicals and green energy remain the growth avenues. It primarily focuses on solar and wind energy and aims to achieve 0.18 MMTPA of green hydrogen by FY30. MMTPA is million metric tons per annum. It has guided a 6% production volume CAGR over the next 3 years. It is trading at 0.9 times consolidated FY26 price to book, despite boasting a consolidated FY26 expected ROE of 17.2%. Sharp re-rating of HPCL, 55% subsidiary, HPCL is a subsidiary of Gail, ONGC, and other listed investment, rupees 44 per share ex HPCL remain the key catalyst for ONGC. Lack of credible and development pipeline, basically for its oil business, may hurt its growth outlook. ONGC domestic production is likely to increase both for gas and oil because of better efficiency. So that will keep it, at least for these valuations are justified, but it is not increasing drastically. HPCL's book or the balance sheet is improving. So the net debt to equity is going down. So that should be good for the earnings of HPCL, which is a subsidiary of ONGC. These are the assumptions. So the assumption is around 84 to 85 is the rate for INR USD, and gas price at around 7 MBTU and Brent crude at around 85 or that is being planned for. So domestic oil production and all is expected to be reaching around 47.9 and gas combined. So considering realization of $85 and windfall tax related to that. So the net post windfall will be around 70, 73 throughout. So in case the gas or the oil prices go up, the windfall will also go up. So they are expected to do a consolidated EPS of around 56 in FY26. In addition, ONGC has interest in other subsidiaries and is getting into other businesses like Opel, ONGC Petro Additions Limited, petrochemical complex at Dahej to make ethylene, propylene, and other polymers. The key issue is execution to see earnings and valuation. So it is expected to do around 56 EPS, as we have discussed, with rise in sales and profits. So EPS growth is around 8 to 10% over the next 2-3 years. So the book value is expected to be around 339, 340. So it is below the book value. ROE is expected to remain good at 17.2 and PE is reasonable right now. It's not very high. So there's a lot of value here. Price to book is below 1. So this is a chart. So if you remember, if I showed you, there's a flag and pole breakout, which was likely last week. So which took place. So you see here, it has broken above this. Now, what is expectation should be as per this technical chart from the base of this pole, which is at around 190 out. So 190 to 290 is 100. And the base here is around 260. So it can go in this momentum to around 360 also. But that is just a technical factor. The last stock today is Bajaj Finance. It reported a strong business update for Q1 FY25 above guidance. Customer franchise stood at 8.811 crore. That means they have 8.8 crore customers. AUM growth was strong at 31% year on year and 7.1% Q on Q, led by healthy new loan booked, customer acquisition, and ability to cross sell in their competitive advantage. Deposit growth was also healthy at 26% year on year. Company continues to derive benefits from diverse loan portfolio, a wide distribution network, and effective execution. It has significantly strengthened its technology, digital platform, and product offering by launching that super app. It is guiding for AUM growth of 26 to 28% in FY25, led by mortgages, commercial, SME, and newer product segments such as cars, LAP, against property, and tractors. A shift in product mix towards secured asset and increase in cost of funds is expected to result in NIMS compression. Overall, asset quality remains healthy except in case of unsecured segment, which they're trying to reduce, such as rural B2C and SME and sales finance. Company resumed sanction and dispersal of loans under e-com and Insta EMI card and issuance of EMI cards after the RBI removed restrictions on these businesses on May 2nd, 2024. IPO is on card for Bajaj Housing Finance, so that will be additional money which will come to them. If you see their valuations, net interest income is expected to grow roughly around 25 to 30% year on year. Similarly, PAT and EPS is expected to be around 366 for FY26. So with the ROA coming down a bit to 4.5 and ROE staying stable at around 22.9%. So it is now trading below, for FY26, it is at below 20p. So below 20p, it can easily trade at whatever is ROE is there. So there is some upside. It is at bottom of valuation and with price to book around 4.4. So it can easily trade above 5 price to book. The guidance was of only 26 to 28% AUM growth. So they grew more than that year on year. There is strong business momentum. But 30 to 40 basis point NIM compression is possible in first half FY25. So branch expansion has been strong. So if you see here, they have been adding branches, focuses on rural areas. So they have added more branches in rural areas as a new stream to improve business. Here, if you see here, ROA is expected to come down, but NIMs are expected to come down because of that. But ROE is expected to be stable, so that should help profitability. AUM growth is strong, so 31% year on year, and they've added a decent number of fresh loans in the last quarter. So that is good. It is nearly now 3.5 lakh crore. So that is good. See how diversified their asset base is. The bigger one is home loan and urban B2C. So they are trying to reduce the unsecured part and increase the secured part of the assets or business. So which will affect the NIMs because for unsecured loans, there is a higher interest rate, while for secured ones, the interest rates are lower. Now, seeing the chart, it has declined from October last year when it made a high, and it has constantly declined. And now it has come to, if you see on the weekly charts, taken support at around 7,000, which is 20 and 50 EMA. It can go down to this 6,800 odd levels, where from there it will be a good buying opportunity. And the low which it made was at around 6,200. So these levels should be a great opportunity to enter this stock for long term. I have finished. We will take questions now.